Today, we're going to talk about one of the most powerful, but honestly, one of the most overlooked corners of the financial world. We're going to see why the bond market, this kind of a quiet, long-term place, can sometimes shout the absolute loudest warnings about where the global economy is headed. All right, let's get into it.
And you know, this quote just nails it. See, unlike the crazy up and down energy of the stock market, the bond market, it works on a totally different clock. It speaks a different language. But learning that language, it's absolutely essential, because when this market sends a signal, history shows it's been shockingly accurate.
And that's really the whole point of our explainer today. There is a very specific and historically a very reliable signal that's flashing red right now. But to really get what it's telling us, we first have to understand the market itself.
So yeah, before we can decode the warning, we've got to understand the machine it's coming from. I mean, what exactly is this massive market, and why do people call it the very bedrock of the entire financial system?
Think of it this way. At its core, the bond market is just a giant lending platform. You know, when a government needs cash for a new highway or a big company wants to build a new factory, they issue bonds. And investors, we're talking everyone from huge pension funds down to individuals, they buy these bonds. They're basically lending out their money in exchange for getting interest payments and then getting their original money back down the road.
And this is the really crucial part. This isn't some abstract game happening on Wall Street. The interest rates that get set in the bond market, they're called yields, they directly impact the rate you pay for your mortgage. They affect how much it costs for a small business to get a loan. They even determine how much it costs the government just to keep the lights on. They are the absolute foundation for borrowing costs everywhere.
Okay, so if the bond market is the foundation, how do we actually check for cracks? Well, the single most important tool we have is something called the yield curve. You can think of it like a barometer for economic weather.
That might sound complicated, but it's not. All we're doing is taking a quick snapshot of interest rates. We just draw a line on a graph that shows the interest rate for borrowing money for a short time, like a few months, versus borrowing it for a really long time, like 10 or even 30 years. And the shape of that line, it tells us this incredible story about what the smartest people in the market are expecting to happen next.
So over here on the left, you've got the normal curve. It slopes up. That makes perfect sense, right? You'd demand a higher interest rate to lock your money away for a longer time. This is the sign of a healthy, growing economy. But then, look at the right. That is an inverted curve. This is when everything gets flipped on its head, and you actually get paid less to lend for the long term than the short term. It's a massive warning sign. It means investors are so nervous about the immediate future that they'll take a lower return just to keep their money safe for years to come. It is a powerful vote of no confidence in the economy.
And look, this isn't just some academic theory. This specific signal, the inverted yield curve, has one of the most powerful, almost scary track records in all of finance for predicting that big economic trouble is right around the corner. I mean, just look at this pattern. It is undeniable. Time after time, a major inversion of the yield curve was followed by a recession. The slowdown in the early 90s, the dot-com bubble bursting, the 2008 great financial crisis, and even the short 2020 downturn. The warning sign was there first every single time.
Let that number just sink in for a second. 9 out of the last 10 recessions in the US were called in advance by this one indicator. There are almost no other things in economics that have that kind of predictive power. And that's exactly why when it happens, everyone who manages serious money sits up and pays very, very close attention.
So the big question is, why? How can a simple shape on a graph have such massive, real-world consequences? Well, it's all because of a ripple effect, a domino effect that touches every single part of the economy. It really does set off a chain reaction. First, the curve inverts. That makes it way less profitable for banks to lend money, because their whole business is borrowing short-term and lending long-term. So what do? They tighten up their lending. That makes it harder for businesses to get loans to grow and hire people, which of course hurts their profits. And when profits are expected to drop, well, the stock market is sure to react.
And you can see that impact right here. Now, the stock market can sometimes keep chugging along for a little while after an inversion, but on average, the performance in the year that follows is often flat or even negative. It's a huge contrast to what you normally see. The chill from the bond market, it eventually spreads everywhere.
And because our financial world is so deeply connected, these effects go global. An inversion in the US makes central bankers from Tokyo to London rethink their own plans. It makes currency markets jump all over the place, and it can affect the flow of money, what they call liquidity, around the entire planet.
And really, this quote just says it all.
This isn't just some local issue for one country. The U.S. bond market is the global benchmark, and its signals are broadcast worldwide. Every major player is tuned in.
So, there you have it. We've seen how the quietest market can send the loudest warnings. We understand the signal, that inverted yield curve, and we've seen its incredibly powerful track record. Right now, that signal has been sent. And while history is only a guide, never a guarantee, it leaves all of us with a really big, really urgent question to think about. What happens next?